So that's a great segue. So Alex asks a question about energy. He says, any interest in SMRs, advanced small modular reactors, given what's going on in Europe with the Russia-Ukraine conflict and people struggling with their energy sources and things like that, and then as a byproduct, like a company like NewScale. Thoughts on that?
You have can you put up the YCG presentation and take us to the energy slide?
Yes.
So I think the short answer is no. There's really not interest, and the main reason for that is because there you go. So the real price of energy consumption declining. So this is basically it's showing you what percentage energy is as a percentage of our budgets over time after you strip out inflation. What is the real cost of energy to our wallets? And so it used to be about 15% of our wallets, and it's come down to about 5% of our wallets. That is what we're referring to when we say the industries are competing against each other, and they're basically in secular decline, and most industries are deflationary. Whereas the industries we're trying to participate in are maintaining their share of wallet. So like Elliott brought up owning Aon and Marsh Mac, two of the largest insurance brokers. Well, as there's more discretionary income in the world, people spend more money on insurance to protect what they have, to keep their assets. And so it's like a relative good that insurance as a whole tends to maintain its share of GDP. Or another, and by the way, and then if Aon and Marsh Mac have pricing power, then it means they act as like a toll collector on the growth of all insurance over time, as acting as a broker in that industry. And so it's almost like built-in growth forever, so long as they maintain that pricing power. And then there's the advertising industry. That also is a relative good. So if I'm a business and I'm advertising, if I advertise a lot, my competitor needs to advertise a lot just to maintain mind share. And so everybody's throwing their resources to get that mind share. And so advertising has been relatively stable, maintaining about, we'll call it 1% of GDP over time. And so then again, businesses like Facebook or Google, Amazon with their search component, and many other businesses that might not be in just digital advertising, but in general, advertising maintains its share of GDP. Those businesses, if they have pricing power, can almost act like a toll collector on the growth of advertising over time. So as the world wealth, as more business is conducted in the world, GDP goes up, so does total advertising expense, and so does their percentage of that action, of that total advertising growth. So coming back to this energy, it's the opposite. It's in secular decline in general. So you might have a short-term bump up, but we're trying to avoid things. We want to buy something we can own for 10 years and be confident that it'll continue to compound and grow.
Yeah. And I would just make the point, like if you think sort of broadly about, history, particularly since the Industrial Revolution, it's sort of a consistent story of our innovation causing our necessities to become cheaper, and then opening up more disposable income to spend on things like entertainment, like status, because advertising is essentially, companies competing for status and attention in the minds of consumers. And then, like luxury goods is another category, cosmetics, things like that. As innovation keeps bringing down the cost of necessities, it's likely over time that a higher share of income will go to these categories like luxury goods, cosmetics, insurance, advertising, et cetera.
All the stocks we've mentioned should not be considered a recommendation to buy or sell the stock. Consult your financial advisor for your specific situation. You can also request from YCG a list of all the securities that we've recommended over the last 12 months. Thanks for watching. Check out our other videos and we'll see you next time.